Most investors are focused on the right things: diversification, costs, long term thinking. But in taxable accounts, there's a silent opponent that rarely gets enough attention: tax drag. Think about two investors, same investments, same market exposure, but 20 years later, one has significantly more wealth than the other. Not because they picked better stocks, because one ran a tax efficient system while the other didn't. I like to say that pre tax returns are the scoreboard, while after tax returns are the paycheck. And for executives dealing with RSU vests, NIIT exposure, and concentrated positions, this distinction really matters. Before we go into solutions, let's make sure that we understand the problem. There are three ways that taxes show up in a taxable account, and two of them catch people completely off guard. First, dividends and interest. Every year, your investments generate income, and even if you reinvest every dollar, you still owe taxes on it. Second, and this one surprises a lot of people, mutual fund capital gain distributions. The fund manager is buying and selling securities inside the fund all year, and when they realize gains, they pass those gains on to you, even if you never sold a single share. You get a 1099 at the end of the year and think, I didn't sell anything. Why do I owe taxes? Because the wrapper matters. Third, and this is the one most people know, realized gains when you sell. Short-term versus long-term, which shares you sell, and for those of you in high-income households, the 3.8% net investment income tax that layers on top. NIIT isn't a boutique issue. In fact, for most executive households, it's just the default. So what do you actually do about it? I think about it in tiers, from foundational to more strategic. Step one is stop the obvious leaks. The simplest starting point is the wrapper selection. ETFs, in most cases, are more tax efficient than mutual funds inside taxable accounts. The reason is structural. ETFs use an in-kind creation and redemption process that typically avoids distributing capital gains to shareholders. Same market exposure, fewer tax bills. If you're holding high turnover active mutual funds in a taxable account, that's a structural leak worth addressing. Tier two is make tax loss harvesting a system, not just a one-off move. The core idea is that when a holding drops in value, you sell it, realize the loss, and immediately replace it with something similar. You maintain your market exposure and you generate a loss that can offset gains, including up to $3,000 of income per year with the option to do carry forwards in future years. Here's where it can go wrong: the wash sale rule. If you sell a security at a loss and buy the same or substantially identical security within 30 days of the sale, the IRS disallows the loss. And this mistake may not be obvious. It could be an automatic investment into the same fund or a spouse's account buying back the same holding. These can quietly destroy the tax benefit you are trying to capture. The solution is treating this like a system with a regular monitoring cadence, proper replacement security selection, and household level coordination. Tier three is control which shares you sell. When you sell a position, you're not just deciding what to sell. You're deciding which shares to sell. And if you've been building a position over multiple years, some lots have a much higher cost basis than others. Selling the high basis shares first minimizes your realized gain. This is called specific identification, and it requires intentional record keeping and a deliberate sell decision each time. Pair this with a capital gains budget, especially if you're rebalancing or unwinding a concentrated position, and you start converting reactive decisions into strategic ones. Tier four is direct and custom indexing, and it can be the most powerful tax loss harvesting engine for the right investor. This is the one I want to spend the most time on because it's often misunderstood, and for executives, it can be the biggest lever. Here's the concept. Instead of buying one ETF that tracks an index like the S&P 500, you own the individual stocks directly. hundreds of positions within a managed account. So you still get essentially the same market exposure as the index, but because you own individual names, you can harvest losses at the individual security level, not just the fund level. And that's the key difference. With an ETF, you have one position, and if it's up, you can't harvest anything inside it. With a direct index, even in a year where the overall market is up, there are almost always individual names that are down. And those losses become tax assets that you can deploy elsewhere. Let me make this real with a scenario. I work with a client, we'll call him Michael, who's a VP at a publicly traded software company. He has RSUs vesting every year, which means he's realizing capital gains whether he wants to or not. On top of that, he had a significant taxable account he had built up over years, which had a mix of ETFs and individual stocks that he had been casually managing on his own, but no real system behind it. The problem was that every time his RSUs vested and then he later sold, the tax bill was significant, and there was nothing in his portfolio working to offset it. We transitioned that taxable account into a direct index structure benchmarked off a broad US equity index. Same growth orientation he wanted, but now throughout the year, that account is harvesting losses at the individual stock level. And those losses flow directly against his RSU gains. We also set a capital gains budget for the transition, so we didn't have a major taxable event while we were getting the account restructured. The result? Same market exposure, better after-tax outcome, and a portfolio that now has a job that is tied to the rest of his financial plan. And there's more to direct indexing than just tax loss harvesting. Because you own individual names, you can apply customizations that simply aren't possible with an ETF. Michael's company had blackout periods where he wasn't permitted to trade in his company's stock. We could exclude that name entirely from the direct index with no unintended compliance issues and no exposure that he wasn't meant to have. For some clients, that customization could be values-based screens, such as no fossil fuels, ESG criteria, or sectors-based exclusions. Or it could be a multi-year transition plan for someone sitting on a highly appreciated, concentrated position that wants to diversify without creating a massive tax bill all at once. One caveat here is that direct indexing works best when the account is being added to over time. Regular contributions create fresh tax lots, which means more harvesting opportunities. In a strong multi-year bull market where everything is up and there are no new inflows to the account, the harvesting opportunity naturally declines. It's not magic. It's a systematic way to capture losses when they're available. And for the right investor with the right account, it can be a meaningful advantage. Tier 5 is strategic gain harvesting and the charitable endgame. Two more tools here that are underused. First, in years where your income is unusually low, maybe there's a career transition, a sabbatical, or for a business owner, a business reinvestment year. These can be opportunities to deliberately realize gains at a lower rate. This resets your cost basis and reduces future tax exposure. It's the less discussed sibling of tax loss harvesting and can be a real planning lever when the timing is right. Second, if you have appreciated securities and a giving intention, donating those shares directly instead of selling and donating the cash can allow you to avoid capital gains appreciation while still potentially claiming a charitable deduction. For executives with recurring gains and the desire to give, this can be one of the most tax-efficient combinations in the entire toolkit. Before we wrap, a few quick corrections on things I hear regularly. I'm only taxed when I sell. Not true. Distributions from mutual funds and dividends create taxable offense even without a sell decision. Reinvested dividends aren't taxed. They are. Reinvestment is just what happens to the cash. The income is still taxable in the year you receive it. ETFs are always tax-free. More tax efficient, yes. Tax-free? No. Tax loss harvesting is always a good idea. It is, but only if it's done cleanly. A wash sale violation doesn't reduce the benefit, it eliminates it altogether. Direct indexing is just for ultra high net worth investors. It used to be. For the first couple of decades, it was primarily a tool used for $100 million plus private wealth clients. That's changed. And for executives with significant taxable accounts, it's now an accessible and practical option worth consideration. Here's the core takeaway: your investment strategy needs a tax strategy. They're not separate conversations, they're the same conversation. The goal isn't to change your exposure to markets. The goal is to get more out of what the markets give you. Wrappers, tax loss harvesting, tax lock control, direct indexing, bracket planning, charitable giving. None of these is complex on its own, but running them together intentionally with a system, that's where after-tax alpha actually comes from. Now, if you want to see how this fits into a broader investment framework that's built around your life goals and your timeline, check out my video on life-driven investing. I go deeper on how to structure your entire portfolio around your next 1, 5, and 10 plus years. So every dollar you invest has a real job description with a real date tied to a purpose in your life. Thanks for watching, and I'll see you in the next video.